Hello, folks. Welcome to State of the Market. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone today. So today is Monday, February 23rd, 2026. And today we're asking whether the NASDAQ could have a comeback. Now, I think as a lot of people know, we have been in a period of rather significant kind of value outperformance and things like that. Things like financials, materials, industrials, all those sort of areas. Maybe not financials so much recently, but a lot of the kind of value areas, non-growth, non-tech, have been leading recently. And so I think what's interesting is last week we had some signals that maybe that could actually start to improve. Now, next week, a second, we actually have our, it's strange. Let me skip that and go ahead. All right. So anyway, show you the standardized returns from ETFs. Remember, we are going to be in Florida for our master class. Hopefully, we'll see some of you guys at that. And that will be on Thursday. We're going to be in Plantation, Florida. Here are the standardized returns, some of the ETFs we're going to be talking about. So today, I think that the thing that is really most kind of interesting is that we have extreme uncertainty. I mean, I don't know how else to put it. It's very sort of confusing environment with both the tariff thing and just a kind of continued military buildup in the Middle East that has people certainly, to a certain extent, speculating or worried about what might happen. And these are just things that are just completely unknown of even how to, adjust them. I mean, I don't know if we've ever had a situation like the tariff situation or the Supreme Court saying one thing and all this money tied up, not people not clear where it's going to go. So these things have a significant sort of kind of uncertainty. I think it's important to realize that the market is holding in a range with tremendous uncertainty. And I think at this point, though, it might create some potential things to resolve in a positive direction. So the very first thing that does kind of stand out to me, if we look at here at the Nasdaq, is essentially the fact that we are kind of holding a level here. If you look at this low, that is, no, I'm sorry, this low we went under last week and we held and we had a bullish outside day. We're just holding it today, and I think it's the key thing is that we're just holding and sitting. What was interesting though is that Nvidia reports earnings, as you know, Wednesday afternoon. So what's interesting, if you look at this chart on a longer term here, I mean, this might be viewed as a longer term consolidation with potential of some more to the upside. And I think it's important when you look at stocks like Micron and Western Digital and some of the different companies involved in the, fiber optics and things like that. The data center trade, there's really no evidence of it really breaking apart. Yes, we've had some issues with things like Blue Owl and some of these sort of things, but overall, there hasn't been a lot of confirmation that there is necessarily anything really confirming that data center demand is going anywhere. So I think when we get to Nvidia earnings, that creates a certain kind of backdrop we got to think about. The other thing is today. Well, first I'll mention for last week. Look at Alphabet. Last week, Alphabet held a very important level. This level on December 17th, the 100-day moving average. I think we can put it on there. You can all see it came right up and hit that. So this is now an important thing. I mean, I think you got to realize is that communications have been an important part of tech, of the growth trade of the Nasdaq. They've been moribund for a while here. Meta has been struggling and everything else, but this bounce we got last week in Alphabet, the upgrade today, also these things now create an environment that does maybe allow people to pivot back to large cap growth, and I think that's an important thing to realize here. So today we have Nvidia and Alphabet, both with some very significant sort of things well, I would say just it makes people ask, is there more downside, or is at this point a time where a lot of negativity has happened and the next set of news going forward could be potentially more positive? I think that's really a spot where we have to ask now. And so we've had a lot of these things of geopolitical, tariff, all that sort of stuff that has created a lot of risk that is just like these big, frightening things. But then we have the realities of NVIDIA earnings. We have the realities of Alphabet holding the mid December low, the 100-day moving average, whatever this analyst note today was. I think I can't remember, as well as Fargo. So those are realities to a certain extent you can think about. Those are things that are potentially more concrete than the geopolitical uncertainty and fear. So I think as you realize is that if attention pivots back to things that are more substantive and real and less uncertain, um, then it may create the potential for sentiment to get better from here. I think it's important to realize that we're at a spot now where things are actually very negative. Now, of course, if something bad happens militarily, or causes an oil crisis, or if you have a situation with the tariffs that gets worse, that absolutely can overshadow these issues. But those are also giant maybes. It's not a maybe that Nvidia reports on Wednesday afternoon. So that's, I think, important to realize. Now, it's also interesting is today we do see more weakness with the software companies. All these cybersecurity companies are struggling because apparently Anthropic has a new cybersecurity AI thing that threatens them. We've said for a while here that software is just a very challenged area. I think that's not changing, but it's also known now. And I think that the thing that is now coming in is, like I said, the communications, the XLC, things like Alphabet potentially, seeing if that does become more of a positive that might offset that. Now, I think what's also interesting is that the macro environment, in some ways, is actually, the tariff thing is out there, but like in some ways, it's less. I mean, the tariffs are an issue, but the Fed is less of an issue in many ways. The Fed. It's interesting to look here at the CME Fed Watch tool. You can actually see that nothing has really changed for a while here. We've essentially have for a period of time some pretty good stability that the market is essentially expecting the first rate cut in June. Nothing's really changing there. But I think also that creates an environment where it's more positive for large cap growth and it's less positive for small caps, less positive for value. If we're moving away from the narrative of rate cuts, that actually brings people back to secular growth stories and away from the kind of idea of you know rates going down and what that does for things like small caps, because that's in many ways when the rate if when if the market has a conviction that rate cuts are coming, the the textbook at this moment says buy small caps, and if we're not in a period of rate cuts coming, then it's more avoid small caps. And I think we are starting to see the last few days. It's been very interesting to see relative weakness in the small caps and a little bit of improving stability in large cap growth. So I think that's kind of how I see these things now. Something else is happening that is, I think, interesting, which is Eli Lilly had a double dose of positive news today. They had an issue. They had Novo Nordisk had a competing drug that did poorly in a trial, and then the FDA approved a new single dose of Zepbound, which is one of their obesity drugs that in theory could boost it. Eli Lilly here has been very tight, and I think people might want to actually take a look at some of the big pharma names here. People might want to be thinking about some of these names because we did a trading view idea on Amgen recently. It has been holding after this earnings and this breakout. Gilead has had this interesting run as we talked about as it was breaking out along here, and people might look for this to kind of chop around kind of 147, see if it can kind of hold this candle from back here on February 10th. The 21-day moving average exponential is coming up. So people might see a little bit more downside in this down toward kind of the 145 to 147 area. But this is also a name here that is broken out, and people might actually be kind of looking at that. So Amgen, Gilead, and Eli Lilly, these might actually create a new sort of vibe with healthcare. And I'm going to get to healthcare, but the healthcare chart on the weekly now is starting to look like a spot where people might actually see the potential for some kind of follow through to the upside. So my overall kind of observations now are that things like communication, healthcare, and potentially technology may be getting a little bit more stable, and things like financials, especially more in the weak camp, and potential kind of emerging weakness in things like industrials, consumer discretionaries, and the Russell. Um, so I would say overall that right now the thing that stands out to me as a risk is the financials. The XLF here has had a lot of issues, and this is, in many ways, I think the biggest kind of risk emerging for the market is what we're seeing in the XLF. Um, so that's one thing. And then overall, though, I would just emphasize that at this point, the market is in a range. It's a very clear range on the daily chart. You can see between pretty much 6790 or 6800 up to around 7,000. It's a 200-point range. And, it's one of these things that make people want to absolutely hit their head against the wall. But it's interesting just to realize, that it's going sideways here, and there are positives when you actually take a step back. Earnings have been very strong, and we have the expectation of double-digit earnings growth basically we had it in Q4, which is almost entirely done. After Nvidia, Q4 earnings season is pretty much done. There's a few more coming, but then after that, the market is expecting, Wall Street's expecting double digits every quarter this calendar year, which would lead us through to January of 27 in terms of the reporting cycle. So double-digit earnings growth in Q4 of 25, and then double-digit earnings growth expected for the next 4 quarters going. So that is an environment that's hard to argue with. The other thing is that there's not really any clear sort of over leveragedness in my view. From what I can see, you basically see a lot of cash on the sidelines, and most of the sentiment surveys actually suggest that people have been de-risking and have been worried. Actually, I want to remind you, go to tradestation.com, go to insights, go to market insights. We have our the article here that a lot of the points I'm making are actually in this article, but there was something in this article that was interesting. I believe I have it down here in this part called charting the market, but LSEG, which is part of Reuters, I think it's the old Lipper or something, like they used to do these fund flows, but they said last week we saw the biggest inflow into stock funds since mid-January. So this does actually show that people have been de-risking. And if you look at things like the American Association of Individual Investors, National Association of Active Investment Managers, they put out those indexes. Those have shown people de-risking. So there are reasons to think that people have been actively selling. And then, that's just the point, is if the people have been selling for a while and now they're starting to kind of come back. And now why are we weak? It's because of geopolitical risk. Again, most of the time, geopolitical risk does fade. So the thing is, if it fades, the question then is, does the sentiment pivot from geopolitical risk to double-digit earnings growth, Nvidia earnings, Alphabet holding that key level? That then becomes the kind of issue. And I think that's just what I wanted to kind of mention here. So there's a reason why we're stuck in this range, like you can see on this chart as well. The reason is because there are positives that people can see out there. And it's also interesting to look, this is a 200-day moving average. Look how it's moving absolutely sideways, completely unclear. So there are definitely things here that could worry people. I actually did a trading view idea about how it hit resistance here and everything else. But to me, I think the thing though is that it really hasn't been confirmed. You can see the resistance level was hit right here on the 18th. And look at this next day on the 19th, we came down and we just did not break lower. If this was going to be resistance, I mean, people would have wanted to see it kind of break lows, and we came back the next day and now we're down again. But why are we down? Is because it's geopolitical. It's not like Nvidia came out and lowered their earnings estimates or something. So I wanted to kind of put that out there, is that basically, this resistance level hasn't really held the market back. And then I think the real question here is, if we can kind of hold here and then we get to Nvidia, and if the numbers are positive, does that actually make sentiment pivot the other way? If the geopolitical stuff doesn't turn into something really, damaging, then we're, could be sitting in a spot with, double-digit earnings growth and, Nvidia earnings coming in a very tight range. And it's also interesting just to realize that, a range like this, if it breaks out to the upside, I mean, it could extend, because when you get stuck in a period of consolidation, the longer you consolidate, as they say, the longer the base, the higher the space. That does create some potential. A long period of consolidation could actually result in some potential upside. I would actually just say that this moment reminds me of way back in early 2012, I think it was, when they had the whole government shutdown with Obama and the Republicans, and it was back around here. And basically, sentiment was so negative, and essentially, they solved the problems, and the market just basically had this. It was so negative and it had been holding throughout 2011 into 2012, and I remember that moment. And then it was just a lack of sellers, and sentiment was extremely negative, and the political risk faded. And this kind of reminds me of that. You had the market had this strong kind of rally, and then it just held for a long time. This moment kind of reminds me of something like that. So I want to just kind of mention that geopolitical risk has historically been something that has not been the actual force that happens. And usually geopolitical risk is something that you fade, that the market has gone against, that has been something that has dragged the market down. And then when it goes away, the price action can move the other direction. So that has been the pattern I've observed now for a while. The other thing I'll just mention that does remain an issue is Bitcoin is very, has some potential risk here. There has been a lot of weakness in Bitcoin that is causing some fear. I don't know very much about cryptos. I don't talk about them very much, but I would be remiss not to mention the fact that, Bitcoin has had, it's been weak. And I think if it does break like under 60,000 or something, that will also cause a degree of anxiety in the equity market, especially in things like the NASDAQ. So I think that's important to realize. Before I get onto the individual indexes, I'll just mention that it is interesting. Today I saw an article saying that mortgage rates at their lowest level in a certain period of time. But I'm just kind of looking, and I don't have a clear idea yet, but I want to just mention the home builders here. I mean, they've been breaking out and starting to push higher. Think, Home Depot. I'm just looking at them. I don't have a clear idea yet, so I don't want to get into anything. But it is interesting to kind of see here with mortgage rates and everything else. People might want to start taking a look at some of the housing related names. Look at Masco. This company makes like cabinets and stuff. Look at this. Had the strong earnings report last week. So I'm just getting into this now and trying to like digest it and find and look around. But I think right now with mortgage rates being lower, the other thing about something like home builders is they are a relatively kind of value sort of area. They are not, really sensitive to a lot of other sort of things. And I think that it's interesting right now to see what's been happening in the home builders because some people might actually see this as being some potential opportunities yet. So I would just say if you might want to take a look at some of these names, but I don't actually have any clear ideas or anything yet. Now, another thing that's kind of interesting is ALB. We're about to do a trading view idea on this one. But it's interesting just to look at this. This is a lithium company. Lithium has been a very interesting part of the market. And I have a trading view idea I'm about to do on this that I'm going to be publishing in like a half an hour or so. But it had this big move back here on January 6th. There was an analyst note talking about how robotics was going to drive lithium demand. You can see we kind of held that level, and you can see this tight consolidation here above the 50-day moving average. So I wanted to point this out here for ALB. Lithium is an underappreciated part of the market. And so this is, I think, something that I want to think about. Another power-related stock is Bloom Energy. They're data center power cells, things like that. But here it is consolidating above this level from November. People might actually view this as interesting. They had earnings last week and it's been consolidating. This might be one that reacts to Nvidia as well. The other thing is I did a trading view idea on Victoria's Secret that has actually kind of gotten beaten down. And this tariff thing does create some risk for these names. But I think it's also important to realize that these companies have had an interesting turnaround. VSCO and TPR, also Tapestry. These are companies that have, their businesses have had potentially, a more lasting turnaround. And people might want to kind of take a look at some of these names because they're in a spot where um, essentially they are no longer in growth. They're in the period of rebuilding. And a lot of these companies trade at relatively low price to sales multiples. And if they manage to get margin expansion, which is typically what happens when you're in this part of the cycle, you downsize stores, you introduce new products, there's no more old inventory to wash out. Everything they introduce, if they manage their business well, could be positive for margins. And when you have companies that trade at a low price to sales ratio and then you get margin expansion, you can get some significant sort of earnings improvement. So this is an interesting sort of name I think people might want to take a look at. These traditional retailers are kind of in a spot here where they've actually been doing kind of well. So I look at the S&P right now and just the overall S&P. Let me go to the weekly real quick. Then we do the weekly chart and the daily chart with this. And again, you can see this range pretty clearly here. And again, I think at this point, this range has been just incredibly frustrating. And I think though that we haven't broken below the bottom of it. And so at this point, people will probably just watch to see and just realize it is this range, 68. On this chart, I have it around 68.05. You could put it down at 67.90. I'm not sure exactly where it should be, but it's roughly 6,800 is the bottom of the range. And I think we should realize that we're still inside of it. And at this point in time, given the expectation of double-digit earnings growth and things like that, it might be something to just kind of respect as long as the support does hold. Now on the daily chart here of the S&P, what was interesting to me was that basically we've started to see a little bit of upside in the RSI, the relative strength index. It's extremely just like neutral here, but it is interesting to see that it has kind of stopped making like this low here was a higher low. And this is something that it's not massively meaningful, but it does also suggest that a lot of the weakness is kind of fading here. And it would be interesting to see if we get up to this level and we don't revisit the low. I mean, this is now a range we're basically in between like 68.15 down to like 60, 830 or 68.25. We're in a 100-point range now. So it was 200, now it's 100. So I think we have to realize is that things are getting tighter here. It's very interesting to see this low from last Thursday hold. I think that's an important sort of thing here that we are kind of trying to hold it today. We had a false breakdown under it. And I think, if we close above this low from last Thursday, which was a low at 68.33, I'm going to actually move this level up to 68.33. That's, I think, important here. So I'm watching that level. Um, that's the S&P. Look at the Qs now. Qs are also in a spot. And what's interesting to me is that you have this low from that the week in late November, the last full week of November, and you can see that we held it last week, and now we're basically inside of that candle here. And what I think is interesting is depending how you look at it, there's a falling trend line here that essentially this is something that does give a certain sense here that there's a falling trend line, but when you see a falling trend line and then you see holding support, historically, in my experience, it's the support that wins and it's a trend line that doesn't win. So I think we have to realize here is that this is setting up now for a potential trend line breakout, maybe. And I want to point that out. We have that trend line illustrated in our article up here. And I think it's just important to realize with Nvidia and everything else coming, you know, it's often a trend line, you stay under it and then you move sideways and then the trend line just ceases to exist and then the catalyst comes and a move comes. So it doesn't have to be exactly a trend line breakout, but it's basically a trend line invalidation. A trend line needs to stop being a trend and just go away. And then what happens is bearishness turns into neutrality, and then neutrality can turn into bullishness potentially. So I think it's important to realize here is that this trend line, even though we went back below it today, we're holding the support around like 600 on the Qs. And like I said, we had this false breakdown last week. We had this low on February 5th. We went below it on February 17th and came back. And then we ended last week with a bullish outside day, and we're still now holding. So we basically had a low around 595 held. Now we're trying to hold 600. This is how things try to kind of bottom. So I think it's important to realize here is that this is something that is giving some potential. And with the news event coming Wednesday afternoon, I think it's important to realize is that this is something that's not breaking. And with the news event, this sense of angst and bearishness will become less of reality. And the real reality, the new reality will be whatever Nvidia says in their earnings. And I think it's important to realize that. That's the cues. All right, now I turn to the Dow though on the weekly. And I think this is kind of at this spot. Now we're getting to the spot. It's kind of like the way things used to be. I think, which is going to be the value and these other like non-tech areas. They just become like Lucy in the football again. You get all riled up about them, and then they just stall. And things like the Dow now, I think, is setting up for that sort of thing. It's back in this sort of range. It's back to the spot where potentially no one really cares about the Dow. No one really cares about the Russell. All they care about is the NASDAQ and Nvidia earnings, or maybe Alphabet as well. So I think right here we have this range. And at this point, from my view, this level, this first week of January, that low, that open level, which was then a support later in the month in January, this could be something people look for a return to, and it just doesn't maybe mean very much of anything. The Russell's in a similar sort of position here. It is tight and moving sideways here, which is actually more constructive and interesting to kind of see what the Russell is doing, but it's also in a very tight range here. So, I think, it's interesting to kind of see that it's actually kind of holding here. But I think also we have to realize is that, with rate cuts less of an issue, and if there is a return to large cap growth and everything, the Russell might have a period here where it drifts. And when things drift, they often have to turn bearish and then they come back to life. So this might drift and then take a dive down toward this sort of level from that first week of February, maybe back toward the highs of December even. And then people will come out of the woodwork on it. So the TNX, the 10-year treasury yield, this has reflecting some fear. And I continue to think, though, that this is actually kind of a good thing here. And I think right here, what's interesting about the TNX is, and I was saying this last week, and I didn't see a lot of attention to it, but I think ultimately, we did have the tariff thing and everything else, but from my view, the market is actually removing tariffs and trade wars as a real issue and as a real reality. And I think that's actually having a positive sort of demand for treasuries. It's interesting that I think, allegedly China told its banks don't buy treasuries and then treasuries rally. I think this whole narrative of de-dollarization and all this sort of stuff could be kind of going out the window, and we could be going back to a sort of reality where people do want to hold treasuries. And like I said, the thing with inflation and rents, in my view, I think that is a more important thing potentially than what tariffs mean for inflation. And I think we could be in a spot here where inflation does continue to ease lower, and it allows the long end to come down, the yield to come lower. So from my view, this is actually pretty important here to see this weakness in the 10 year. And so I think this is actually something which it does show a degree of fear, but it also, remember, at other times we had fear, it moved higher. Back here in like April of last year. I mean, when we had a whole Liberation Day thing. So I think we're seeing here is that Treasury yields, this fear of Treasury yields running away to the upside and having the kind of inflation capital flight thing. That narrative doesn't seem to be happening, and this is another sign of things coming back to normal. I think people need to kind of see is maybe taking shape. XLB materials. This has had a tremendous run. We had talked about this breakout, and from my view here, this is something now people can just watch it stabilize. And like I said about the Russell, this is actually pretty correlated to the Russell, and I think here you could see it basically move sideways, and see if it comes back and tests that level from the first full week of February. If it can get back to that close around 51 and a half, from my view, that's something here. Materials have had this run, and at this point, they maybe are set up for a period of sideways movement. These have nothing to do with Nvidia or tech. If people are coming back and buying tech and interested in tech and things like that, then materials is not necessarily an area they're going to be enormously interested in. Communications, though, now this I think is interesting. Look at, we held this level. We made a slightly higher low versus where we were in late January. And like I said with Google or the Alphabet, and I'm not really sure what's happening with Meta here, but Meta I know is kind of just, it's not breaking to new lows or anything here. I think these names are in a spot here where now people could actually start to wonder, if communications hold. If we get, remember, communications have been a very strong weekly chart. If we get more upside in this could change the overall narrative here, and make more of a return to growth. So Meta and Alphabet, I think now, and especially Alphabet, I think are important to watch. This pullback in Alphabet, holding this level. Look at this level here. I just have to emphasize this is a very big deal in my book. Holding this level, and then basically this note today, the analyst note today. I think that's an important thing that could see continuation, or we could see ramifications of it afterward. XLE here, from my view, we see this breakout to all-time highs, and this is now so intertwined with things in the Middle East and everything else that I think it's just pretty hard to have a clear view of. And I would just say that energy has broken out to a new all-time high. That's interesting. But also the risk is, if the situation in the Middle East, improves in terms of no conflict, then energy could have, significant pullback, or, people might look for a pullback toward even, toward 52 or something on XLE. So I think it's important to realize now that technically this is now not even a technical chart. This is a purely geopolitical sort of thing at this moment in time. But just to realize it's had this move, but also to realize historically we do seem to have had a legitimate breakout in XLE. And it could mean that if we do get some weakness over the following weeks and month or so, if we do get some downside in the energy, it could provide an opportunity for people looking to enter the XLE. XLF, though, this is looking very challenged. And I think this is, to me, my biggest concern here. And I do think we do see some risk down to the levels under 50, way back to these levels from May of last year. Financials here have a lot of, there's a lot of concerns about them. And I think the real issue is that, and I've said this all along, is that ultimately, OpenAI is supposed to go public. Anthropic, some of these giant, high multiple growth names are supposed to go public. And that, in theory, should create this great tech IPO market. But the problem with OpenAI is it's a software company. So you can say all day long that, AI is going to be this huge growth, and obviously has been. But the problem is that the valuations on these, and to a certain extent, have the risk of being reset and causing well, maybe there is no IPO or maybe it's smaller. And I think you have to realize is the financials here have that kind of new risk added to them, and obviously the geopolitical risk of tariffs and things like that. So I want to just kind of mention that here that financials here to me are, a significant sort of risk to the market. And, we should realize that the market is range bound and that if things there is absolutely the risk that they break to the downside. And it could be financials that pull the whole market lower. So this is something I think should definitely be, watched and monitored here. That's the XLF. XLI has had a very significant move, but also people might look to consolidate, like the Russell, like the materials, like energy. This is something here where it's had, this significant run, and now there might not be very much opportunity left in the XLI in the next couple of weeks. XLK here, and I think is very interesting. We see this falling trend line, and here it is, been holding this level around 138, and that's just kind of what I want to watch here to see if it continues to hold this level. It's like that line on the Qs. If it can hold that support and turn into a breakout, that is a potential to watch. But I think at the same time, we have to just see what happens. But this is, I think, the important thing to realize: if it can hold this level and then essentially, break this downtrend, that would be something that could create an opportunity. But also, if we break this, then it could turn into much more of a topping pattern. It could have longer lasting, sort of weakness. XLP, consumer staples here had, last week a pullback, and I think it's interesting here that this sector has now broken out, and I think overall, this has had a pretty sharp move, and people might look for this just to consolidate for a while here after this move on the XLP. XLRE is actually now getting, actually, I think people might see some opportunity in the real estate names. They've broken above this level, and we've been saying for more than a year, if they can get above like 43, that would be the area where people might look to add. And I think the things that are happening with interest rates and everything else, this is kind of a safe haven if we have geopolitical risk and things like that, and tariffs and things like that. This area, if we have lower yields, this is an area people might be looking to. So I think we have to realize this might actually turn into something of a rally here in the XLRE. Utilities XLU also has broken out. People might look for it just to kind of consolidate here, but if yields are going to kind of stay down, this might actually be turning into something that turns into a longer term continuation. So from my view here, if this thing can kind of hold back, test back between 46 and a half down to 45 and a half and hold in this area through here, this might actually be something where people look for continuation in the XLU. XLV is the one that's most interesting to me here because it's basically sneaking through this level that goes back. There's this resistance level from late 2024, and now we're sneaking through it. Talked about Eli Lilly, talked about like Amgen, these other names. XLV healthcare here is interesting. So, or it could be potentially interesting. And I would just say when we look at, this idea of safe havens, we're seeing staples doing well. We're seeing real estate doing well. We're seeing utilities doing well. Healthcare doing well. We do seem to be in something of a shift here toward a safe haven market, and this could create a potential for the XLV healthcare ETF to break out. Consumer discretionaries, on the other hand, are more challenged, I think, here, and people see this risk. Maybe this getting sucked down toward this level from late November. I think right here, there's all kinds of uncertainty. There's been people talking about Tesla having issues with their self-driving cars and stuff. So from my view here, this is something here where people are going to want to see Tesla get those self-driving cars rolled out and operational and start, behaving well. There's been some reports about them not necessarily functioning as they should. That's really the key driver here, I think, for something like XLY. Obviously, tariff risk to these to a certain extent, because consumer discretionaries overall. So those are the main things I wanted to talk about. Hope to see some of you guys at our masterclass, and we'll see you next week on State of the Market next Monday. It will be the beginning of March. Have a great day, and I'll see you then.